Global oil and gas market volatility is at somewhat of an extreme level, and that's the subject of this month's macroeconomic special. Here with me now, with more on this, is our chief equity strategist and economist, John Blank. John, have prices retreated from their peak at all?
A little bit, Terry. We're a little under. I'm talking in WTI terms. We're at $92 a barrel this morning on March the 26th, and they were up towards 98, 99-ish not so long ago. So they're at the $100 level. The ceiling seems to be applying for at least WTI. Brent is, a foreign blend, and the premium on foreign oil is higher than domestic oil. So Brent is definitely above 100. I believe it's on 100, above 100 today.
There are many other key questions surrounding this whole situation. What are the core scenarios and probabilities for this Middle East conflict right now?
Yeah, Terry. We should give the military in Israel and the United States credit that the 45% probability that they have degraded the Iranian military capabilities to such a degree that they really are incapable of a major assault in the Middle East. That doesn't mean they can't, of course, get to the other probabilities that they can be a menace and carry on the closure of the Straits of Hormuz, which I also put at about a 40% probability for indefinite period of time. So the 45% probability is just the idea that there was some success with the original objective. The 40% probability is it has not achieved any closure in terms of getting the Straits of Hormuz open and the region functioning in the way that it did before the conflict. That gets to my final 10 or 15%, which is blowing up the Iranian regime so that the people of Iran could have a choice of a democratic or Republican, republic, small r, republic government, some mixture of that. And the answer is that's a very low probability in the current circumstance.
You watch the oil and gas charts regularly. What picture do they paint right now at the charts that you're looking at?
Momentum is up, Terry. We need to also understand real price momentum for the United States. I mean, we're at $95 a barrel at WTI. We need to remember that the WTI was $100 a barrel from 2011 to 2014, not ancient history, and the economy did not slide into a recession during that period of time. So there's no question that we are not going to be delivering a recession from this level of oil prices. What people have told me from the modeling work they have done, Brent between 125 and 150, which is WTI at 120 to 140, is when the camel's back may well break, and we will see meaningful GDP growth estimate revisions that take us towards the recession scenario this year. So we're not there yet, Terry, but the momentum is in the direction of getting there relatively quickly, I would say, within the next 2 months.
Do you see a recalibration of oil production as a result of all of this?
Well, demand and supply being what it is, it gets adjusted by volume and price. So if you take 20% off the world oil market, you have to have price ration the demand down to get rid of that 20%. So that's usually implies a massive spike in oil prices. So that will also supply incrementally more. But the problem is supply for the oil market over a period of 3 months is relatively inelastic, meaning people cannot supply it, which is going to also contribute to keeping the price spike moving up and quicker. So I think longer term, there's some elasticity in oil supplies. Over the next 6 months, there's relatively little.
So, just to clarify, that's what you expect to see impacting the global supply chain for oil?
Right. Then we go downstream, sulfuric acid, you get fertilizers. There's other types of things that helium I've read about that is used for wafer production of chips. A lot of these things downstream will start to be supply constrained along with oil because that's what their oil is used for. And so it has major ramifications for the global supply chain. And that is really where we're going to also see global and U.S. Reductions in growth.
You wrote recently, John, that this isn't just an energy problem, it's an everything problem. So, what do you see happening to U.S. underlying economic fundamentals and the economic outlook going forward?
Well, Terry, there's relatively clear evidence over the last 30 years, going back, well, even 50 years, really, to the 73 oil shock. it started with the oil embargo back in those days, that most recessions in the United States have come in with a major oil shock. So this is actually totally consistent with a recession scenario. Mark Zandi of Moody's, who I respect on recession calls, has a real animated version of probabilities, and he's at 49% for this year, which is only 9 months left of this year for a recession this year, Terry. So we're in a borderline situation under the current scenario, and then the current scenario is very dynamic.
You see the same thing basically on the global level?
Terry, the global level has a lot of leakage because the Iranians can and are allowing oil production to go to China in the middle and to India, and the Russians cannot now get a premium for the oil they can ship if they can ship it out of the bombing that's happening up in the Baltic region right now. But it's very hard sitting in on a podcast like this, getting a grip around the nature of global oil production and supply and demand in an amorphous situation like this. But it may well be that the global economy suffers a little less than the U.S. economy, but there are parts of the global economy that suffer much more.
All right, next we have three Zacks number one strong buy picks that caught your attention with solid long-term Zacks VGM scores, namely Allstate, Telefonica Brazil, and OMV.
Now let's talk Allstate, ticker ALL. This is the great Chicagoland company. Number one rank with an A for value and a VGM score of A. And we got estimate revisions for this year, Terry, up 7.5% and up almost 5% for next year. This company makes $26 a share or so. At a $200 price for the shares, you're getting a little under 8 on the times on the PE. So this is a stock where smart money will rotate into to hide out during this conflict. So keep your eyes on ticker ALL.
Telefonica Brazil.
Telefonica Brazil, if you look at the chart, Terry, it was $12 a share to start this year. It's at $16 a share right now. We had a target price of $18 a share. And again, we got 17% estimate revisions going up this year over the last 60 days and 16% for next year over the last 60 days. So big upgrades to Telefonica Brazil driving the stock north. And actually, Terry, broadly speaking, Brazil has been another safe haven stock market-wise for this conflict.
And I abbreviated this one OMV because it had some other long name that I couldn't pronounce.
Well, Terry, you actually got it right. OMV is the name of the company, and they are an Austria as in Europe, oil and gas supplier. OMV AG is their full name because AG is a representative of that European ticker. They're basically a play. Really strong momentum play this year on supplying oil and gas to Europe, the most stricken part of the world economy for oil production. So you got to love OMV in this circumstance.
Our chief equity strategist and economist, John Blank, on oil and gas market volatility and its impact. And with John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.